The second part of chapter 5 is about recording sales as recording sales. When you're the seller, you're recording sales. When you're the buyer, you're recording purchases. So when we were the buyer, everything went to inventory. But as the seller, there's going to be several new account titles that you'll have. And I had pointed out, I think it was on page 528, that chart that showed the transactions, how to do the transactions for or how to journalize the transactions for both the buyer side and the seller side. That's going to be a very, very important part of your notes for your homework and for your exam, because that gives you all the possible transactions that you could get from the buyer side or the seller side. So today we're talking about the seller side. And again, with this, we are hold on one second. I gotta admit one person. There we go. We are looking at recording for either on account or credit or for cash. So we're doing both of those possibilities. And before, when we did service revenue, we just had service revenue, and then we had the piece that was either cash or the debit to cash or debit to accounts receivable, because we're going to receive the money later. Well, now we have more accounts that come into play when we are the seller. So for every time you sell a product, you're going to have 4 lines for the entry, okay? One of the lines is to recognize the revenue and bill the customer, or to recognize the cash, and the other line is to recognize the cost of goods sold and to get the item out of your inventory. So there'll be 4 lines every time you make a sale when you're selling merchandise, okay? Now, just like before, the book's going to show you the example of the invoice by PW Audio Supply. PW Audio Supply is the seller. They are the one that would make up this invoice for the person they're selling it to, which is Sock Stereo. And that's what we looked at the beginning of this chapter. Sock Stereo was the buyer. You will not be getting any of these, what they call source documents, invoices, to do or to look at. Everything that you get is going to be coming in a paragraph. Okay. All right. So this next slide shows us an example of the 2 entries that you're going to have every time you make a sale. And every time you make a sale, it's going to be the accounts that are listed here. And there's going to be 2 entries every time you make a sale of merchandise. So the first part is going to be, you're going to debit either accounts receivable or cash. And it's going to depend on if they give you terms, you know it's accounts receivable, or if they tell you account, you know it's accounts receivable, or if it says that you're going to be paid at a later date, you know it's accounts receivable. But if it's cash, it's going to say cash or you were paid or something like that. So you're going to debit accounts receivable or cash, and then you're going to credit sales revenue. And this is going to be for the amount that you're selling it for. So the problems that you're looking at will have both a sale price or a selling price, and then they will have a cost. So the first part is for the selling price, and then the second part is for the inventory and cost of goods sold. So the first thing you're going to do is you're going to debit cost of goods sold for however much it costs for those goods that you just sold to that person. Now, the problem is going to tell you how much it is. You're not going to have to figure it out. So each one of the problems is going to tell you, you know, the cost of these goods was 500, 1000, 10,000, whatever it happens to be. And then you're going to credit inventory for the same amount in order to pull the goods out of your inventory. Okay. So we're going to look at a slide to kind of look at an example of this. All right. So it says, PW Audio Supply, which is the seller, records the sale of $3,800 on March 4th to Sock Stereo on account as follows. Assume the merchandise costs Sock Stereo or costs PW Audio Supply $2,400. So $2,400 is the second part of the entry when you're the seller. So they said it's on account, so we are going to debit accounts receivable, $3,800. And then we're going to credit sales revenue, $3,800. That's to recognize the sale of the merchandise. Then we're going to debit cost of goods sold, $2,400. And we're going to credit inventory, $2,400. So that's the amount of the cost, okay? All right. So let me go to the next slide here. All right. Now, when we were the buyer, everything went to inventory, right? Well, when you're the seller, everything does not go to inventory. We have an account called sales returns and allowances, and we have an account called sales discounts when our customers pay early and take a discount. And the reason why we have this when you're a seller is that when you're a seller, you want to keep your number, your sales number, the actual sales that you made. So, for instance, if you were to look at your report for the month of January and you sold $200,000, that would be how much your salespeople worked to sell. Now, if you were selling a product that was defective and you didn't know it and your salespeople didn't know it, and customers were returning it, and you took that money right back out of sales, you wouldn't be showing a true reflection of what your salespeople did, because just because they sold $200,000 doesn't mean that they should be penalized if the product was defective or if the customers didn't like it, and that that it reduces your sales. It also is not a true picture of what your actual sales are if you go back and take it out of the sales account. So that is why we have an account called sales returns and allowances for any returns or allowances. And then we have an account called sales discounts for any discounts that the people take for paying early. And those are contra revenue accounts. So they basically would subtract from the revenue. Remember, contra means opposite. And they are a contra revenue. Revenue is a credit balance account. So contra is opposite. So they are a debit balance account. And we'll look a little bit at these so you can kind of see how they work. All right. So here's an example. PW Audio Supply would make, the grammar's not right on this. Prepare the entry PW Audio Supply would make to record the credit for returned goods that had a $300 selling price. Assume a cost of $140. Assume the goods were not defective. Okay, so when you have a return, you have to give the customer credit and put it back into inventory. When it's an allowance, you are only doing the first part, which is giving the customer credit. So you need to make a note of that for yourself somewhere. If it's on the sales side and it's a return, you have to credit the customer and you have to put it back in inventory. If it is an allowance, which means the customer kept the product, you're going to give the customer credit and that's it, right? So in this case, it was an actual return of the product. So they're giving the customer a credit of $300. So they're going to debit the account, the new account, sales returns and allowances, $300. And then they're going to credit accounts receivable $300. So that's that much less that their customer has to pay them. Okay, that's the first part. The second part, they are going to debit inventory for the cost of the inventory that's being returned, which in this case is $140. And then they're going to credit cost of goods sold. And the reason why they're crediting cost of goods sold is that because this item is being returned, it's no longer sold. So it's no longer a part of the cost of goods sold. You're putting it back on your shelf. So you're going to credit cost of goods sold to reduce the cost of goods sold. Okay. So this is an example of what the entry would look like for a return as the seller. Okay, return as the seller. And we're going to do sample problems with all of these. So, all right. The next one says, assume that returned goods were defective and had a scrap value of $50. Okay, you would still do the problem the same way with two entries, because even though it's defective, you're going to put it back in your inventory, but you're going to put it back in at whatever the scrap value is or whatever the new cost is. And I don't know if you're going to see a scrap value problem at all. I think this is just a sample they're showing you. But either way, it doesn't really matter if it's defective or not. You're looking for what you're crediting the customer and what the cost of the inventory is that you're putting back. Okay. So we are going to do the first part. We're going to credit the customer. So we're going to debit sales returns and allowances, $300, the amount that we're crediting the customer. And we're going to credit accounts receivable, $300, to give our customer the credit. We're then going to debit inventory, $50 for the cost or the value of that defective piece. and we're going to credit cost of goods sold, $50. Okay. And again, don't worry too much about like all of this sticking right now. We're going to go over it in some problems. But this here is also looking at the sales discount part. Remember I said that there's an account now for sales discounts, and it's actually called sales discounts. Now the formula to figure out the sales discounts is actually the same as before when you were the buyer, but the accounts are called different things because you put it into your books different ways when you're the seller versus the buyer, right? So the formula to figure this out, remember before we had purchases minus any returns or allowance gives us account payable. Account payable times the discount percentage gave us a discount dollar amount. Accounts payable minus the discount dollar amount gave us the cash that we were going to pay. Well, now, if you can see here on the bottom of the screen, it says the formula is sales, so whatever the sales were, less any returns or allowances. That's going to give you the accounts receivable number. So sales less any returns or allowances will give you your accounts receivable number. So that's how much you're going to receive from the customer. You then have the accounts receivable number times the discount percentage, and that's going to give you the discount dollar amount. That's the amount that the customer is going to take off of their payment. Then you take the accounts receivable number minus or less the discount dollar amount, and that's going to tell you how much cash you're actually going to receive from the customer. So we're going to look at a sample here using that formula, okay? So assume Sock Stereo pays the balance due of $3,500, which is the gross invoice price of $3,800 less returns and allowances of $300 on May 14th, the last day of the discount period. Prepare the journal entry PW Audio Supply makes to record the receipt of payment on May 14th. So this is where you have to do all the work before you actually get the problem, right? You get the numbers to put the entries. So we're going to go down here to where I have everything written. And as we see here, it says sales minus returns and allowances equals accounts receivable, right? Accounts receivable times the discount percentage is the discount dollar amount. Accounts receivable number minus the discount dollar amount is the cash amount. So we're going to look at this. So the sales were $3,800 minus any returns or allowances, which the returns and allowances were $300. So 3,800 minus 300 means that our accounts receivable number is $3,500. We go to the next line. We can take the accounts receivable number of $3,500 and we multiply that by the percentage discount. And if we go way back in the problem, we'll see the percentage discount is 2%. So 3,500 times 2% is $70. We then go to the last line. We take the accounts receivable number of $3,500 less $70 cash or $70 discount. And that tells us the amount of cash that we are going to get paid is $3,430. So we're going to get paid. So we are getting paid. So that means we're getting cash. Our cash is going up. So we're going to debit cash. How much are we debiting cash? We're debiting cash, $3,430. We just figured out how much that is. Okay. We're then going to debit the contra revenue account, sales discounts for the amount of this discount dollar amount, which is $70. Okay. And then we're going to credit accounts receivable for the accounts receivable number we figured out, and that's going to zero out the customer's account so that they no longer owe the money. Okay. So we're going to go look at the book again, and we're going to look at the samples that they show of all the different entries. So in your book, it's on page 528, and we want to pay attention to the blueprint if you can see the blueprint. The red print is in the right-hand column. We don't want to look at that. That's for periodic. We're just looking at perpetual. Okay. So in the book, the way they show it, it's like this. I'll show the slide here. They show it where the top box is for the buyer and the bottom box is for the seller. So we'll look at that one there. So you can see that they're both the same dates. So they're showing you what it looks like from the buyer side and what it looks like from the seller side. So if we look at the bottom part, this is what we just did. Here's an example on May 4th of the sale of merchandise, and you'll see how they show you the 4 lines that you need, right? Then it shows you the return of merchandise on the 8th, and it shows you the 4 lines for that because that was a return, and so we had to put it back in the inventory. And then they show you on the last line the payment amount that you're receiving. Now, if you look at the box above, if you can see that for the buyer, you'll see that the dollar amounts for the amount of cash and all that are the same, but they're paying it. On the bottom one, you're receiving it as the seller, you're getting paid. On the top one, you're the buyer, so you're paying your bill. Now, the only difference between the 2 dates is if you look, you'll notice that on the top box, it has a May 6th freight cost on purchases. Well, the reason why that's not on the bottom, the seller side, is that the buyer paid for the freight. So it's not going to show on the seller side. It's only going to show on the buyer side. But this is going to be a very important tool for you for the exam. So I suggest that on your note cards that somewhere you make something similar to this to help you so you know how to do the entries from the buyer side and from the seller side. Okay. Let's see. This we're actually not going to do that. We're going to go to